This is Alan Bush with the Daily Financial Futures Forecast for Thursday, April 30th. Starting out with the stock index futures, we are seeing prices lower today. Looks like some follow-through weakness from the very weak GDP report that we had yesterday. However, I'm inclined to think that we will see some recovery later this afternoon, as any economic weakness should be met with a Fed that will be very slow to raise interest rates. So I am looking for a recovery, I would say, in the afternoon hours, even though we are seeing pressure this morning for the indices. Longer term, still looks like the main trend is higher. Over now in the foreign currencies, seeing the dollar index falling to now its lowest level since mid-February. There's a growing feeling that economic weakness here in the U.S. may persist for a while, and this is likely to remain a bearish factor for the dollar index. So our feeling is the dollar will continue to work lower. Seeing the European currencies mostly higher today, led by the euro currency. Also, we did have German employment numbers coming in better than expected, so that also supporting the currency of the eurozone. The big mover today, however, is the Australian dollar, which is sharply lower. This due to fears that the Reserve Bank of Australia, at their upcoming meeting next Tuesday, could possibly lower their main interest rate by 50 basis points down to a record low 2 percentage points. We feel that once that meeting is out of the way, that the dominant influence will be higher commodity prices, especially the commodities that are exported by Australia, will dominate and take the Australian back to new highs for the move. Also, the Canadian dollar, we feel, will continue to advance. Of the two currencies, the Canadian appears to be the better long, but both the Australian and the Canadian, we believe, are headed higher longer term. Moving over to the interest rate markets, a very disappointing reaction in the Treasury futures markets to a very bullish GDP report. If you recall, yesterday GDP came in only up 0.2%. The guess was up 1%, and yet the long end of the curve came under a lot of pressure, and it may be due to more than just the heavy supply that we have from the Treasury of $105 billion this week. So with futures not responding well to bullish news, that is a reason for us now to stand aside in the Treasuries, even though we do believe that the Fed will be very slow to raise rates, probably not this year, more likely into next year. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.